next seminar. My video is not working for some reasons. I apologize, but that's not very important. Today, we are extremely pleased to welcome our good old friend and colleague, old not in terms of age, but in terms of time. We knew each other. It's Professor Cristiano Perugini, of course, from the University of Perugia, but also, I think, lately from IZA Institute of Labor Economics, unless I'm mistaken. Cristiano is well known for his excellent work on inequality, labor, finance, and he is also a recognized expert on transition countries and economies. His degrees are from University of Perugia, University of Aberdeen, and his talk tonight is going to be about credit and income mobility in Russia. Cristiano Perugini, prego.
Thank you. Thank you very much for having invited me. I hope you can see my presentation.
We see. Oh, by the way, lest I forget, please register yourself in the chat column of this Zoom meeting, please. Okay, Cristiano, the floor is yours.
Thank you. As you might have realized from our conversation in the previous minutes, I'm familiar with the environment of Higher School of Economics in Moscow. I've been visiting there 2 times in the framework of projects we have together, and we really look forward very much to start again cooperation in person, and to go back on the very good old habits. And thank you for having invited me to present my work, which is a joint work with Davide Aristei, and it's about credit and income mobility in Russia. And the paper is revised and resubmitted in the Journal of Economic Inequality. Actually, it's even a bit ahead, more ahead than revise and resubmit, but I want to be scaramantic because it's a long way, always. I will start now with some motivations very quickly. Why studying income mobility, and why is in Russia and in relation to credit. Income mobility is interesting because it's basically a bridge between income distributions over time. So it introduces a dynamic perspective into the study of and research on income inequality. And also, when you look at income mobility, at individual income mobility, you can identify factors that trigger movements across the income distribution. So you can identify factors that are triggering movements upwards or downwards of the income distribution in terms of absolute and relative positions. And for those who are interested in poverty, you can also identify factors that are traps, poverty traps, or stepping stones to get out of poverty. Of course, mobility as inequality can be studied looking at different variables. We think that a particularly interesting one is income mobility, so in terms of income, because you can look at different types of income sources and also at the role of the household in terms of composition, characteristics, and all the mechanisms, redistributive mechanisms that happen within the family. Empirical evidence of Russia on income mobility is not very extensive, and this is somehow surprising because Russia is one of the countries belonging to the set of high income inequality countries. So understanding how movements of individual incomes shape this inequality might be very important. And why studying the role of credit? Because credit is very, very often invoked as one of the, and financial markets as one of the main drivers or possible drivers of income inequality, but it's very rarely studied in terms of individual income mobility, especially in the short run. So we want to look at whether if there is an effect in income mobility of individuals, even in the short run, triggered by access to credit. So with this paper, we want to provide descriptive measures of absolute and relative income mobility in Russia in a long time period. And this is allowed by a unique data set that you are all familiar with. We want to identify the macroeconomic factors associated to absolute income mobility at household level, and in particular, the role of credit. So whether access to credit by households is conducive to higher income mobility, and whether we can identify possible channels of transmission from credit to higher income growth. We study Russia from 1994 to 2018, and we look at short-run income mobility, so over 3 years. And our unit of reference is the household. Okay, after this brief introduction, I will briefly go through the breakdown and then talk about our working hypothesis. Background is basically related to the fact that the drivers of income mobility have been studied extensively, and there is a very extensive literature emphasizing how income mobility depends on demographic factors of the household components and of the household head. Also economic factors such as evolution between and within sources of income, the relative importance of them. Then there are some interesting contributions that emphasize the role of institutional settings, labor market institutions, product market institutions, but also the welfare state models. And there is some interesting literature on transition countries, or Central and Eastern European countries, that unanimously, I would say, identifies these economies as economies with high income mobility, which does not mean high income growth, but income mobility, so movements across the distribution. And generally speaking, one distinctive feature between one feature that separates basically what happens in Eastern and Western Europe, if we talk about Europe, is that in Eastern Europe there is a much weaker role assigned to higher education, which is normally one of the factors that are triggering income mobility. So if the household head or the components of the household hold high tertiary, let's say, education, normally this is associated to higher income prospects. And this is not always the case in Eastern Europe. If we look at Russia, there are a few studies of Russia. Lokhin and Ramayan is the first one. And yeah, I'm not going to summarize them all, but generally speaking, Russia is identified as one country with high levels of mobility, which means that people move up and down the income distribution very, very quickly, and also with big jumps over deciles or quintiles. Mobility is in Russia higher even than the US. This is what the EPRD in 2006 said over a long time period. And what is also interesting is that for Russia, income mobility and the evolution of income mobility has been linked, as I said before, to changes in income distribution. So what we observed in Russia is a decline or a stabilization of income inequality. So income inequality stopped growing during the 2010, after 2010, and this is somehow related, especially by Dang and others, and also EBDR. It is related to a change in the structure of income mobility. So during the first stage of transition, so during the 90s and the early 2000s, income mobility in Russia was driven by generalized income growth. So it was a growing economy, apart from some crisis, but it was a growing economy, and this was making the incomes of individuals on average grow. After the 2010, so after, let's say, the crisis of 2007, 2008, this model changed, because now there is a stronger role in income mobility of redistribution, so of transfers. And this we will see also in our descriptive analysis. So income mobility is shaped not by the fact that all individuals are moving upwards, but from the fact that some relevant and remarkable amount of income is being transferred from some households to other households. So the movements are redistribution, are driven by redistribution. And this is hypothesized as one of the forces shrinking the income distribution. Our working hypothesis, why focusing on credit? So we basically refer to two main domains. One is the labor market. So credit could trigger changes in labor supply or labor market, as we will see matching, or in other income sources. So why can credit impact on labor supply? Well, there is a well-known model, the life cycle permanent income model, in which when you are constrained, you have liquidity or budget constraints, you use labor supply, you adjust labor supply to smooth consumption. So when you are under tough liquidity constraints, you basically increase labor supply, or when you have access to credit, you can release, you can relax your credit, your liquidity constraints, and decrease your labor supply. And this is what Rossi and Trucchi in European Economic Review and Bui and Ume in 2016 found. So access to credit triggers a decline in labor supply at the intensive match. So in terms of our hours worked, for a limited, only for males, high educated, so it's for a very limited sample. This view has been very much challenged because whenever you are in the presence of labor market frictions, so going in and out from the labor market or adjusting labor supply is not as easy so it's not easy when you have macroeconomic uncertainty or structural adjustment, which are all features that characterize the labor market in transition economies and in Russia. This effect, this decline in labor supply is very unlikely because people, of course, individuals would not see as a rational choice simply to go out of the employment area simply because they got credit. So because this decision might be not reversible or not easily reversible. So this finding that I just illustrated is quite questioned, especially on the ground that there is, on the contrary, a large evidence that shows that households with loan or mortgages, so that have had access to credit, are more committed in view of debt repayment, and then are inclined to increase labor supply rather than to decrease labor supply. So given the Russian context in terms of macroeconomic development, labor market adjustment, structural adjustment, and also considering what has been identified as the Russian way in labor market adjustment, characterized by substantially stable level of employment and adjustments on the side of wages and working hours, and also on the fact that the spectrum of non-standard employment options is quite limited compared to other European countries or the other OECD countries, we believe that it's reasonable to hypothesize that access to credit in Russia might be associated with an increase in labor supply, which in turn increases labor incomes, and therefore income mobility. So our first hypothesis is that access to credit increases income mobility. Access to credit increases labor supply and therefore income mobility. Our second hypothesis is also related to the credit market, to the labor market, and it's related to job matching. Why? Because based on some interesting literature, we can think of access to credit as a way of relaxing liquidity constraints. So letting people look for jobs and occupations that better match their profile, aspirations, and desires. Because of course, when your liquidity, when you have constraints and hard budget constraints, you are willing to accept any job that allows to make your living and to meet your needs. So you're more inclined to accept even jobs that are not, that you don't consider as fitting to your profile or to your level of education. On the contrary, when you can relax through access to credit, these constraints, this is maybe leaves you the opportunity to look for a better job and to spend more time on search, on labor search, and so improve the match of your job and of the job and workers' characteristics. So our second idea is that access to credit might trigger better matching and higher earnings, because we know that better matched workers have higher productivity and higher wages, and this way favor income mobility. Third and last hypothesis, credit and non-labor income. There is a literature emphasizing how when credit is not taken for consumption, so consumer credit, or when it's not employed in long-term investments in human capital, for example, in the education of your children or your own education, this can enable the accumulation of financial and physical assets. And if you own more financial and physical assets, you can increase income sources that are non-labor income sources, so capital gains or rental property. So if the credit markets are able to allocate efficiently credit to individuals who are profitably using this credit, this amount of resources in a profitable way, then we can also expect that access to credit might trigger income growth via higher returns in physical and financial assets, so capital gains or rents. So these are our three hypotheses. Methods. The methods are, I would say, a standard approach to income mobility. So we define, as you see in the top, at the top of our slide, you see that we consider a function of so as the dependent variable, the change in the logarithm of household equivalized income. So it's the change between time t minus 1 and t in logarithms. So the dependent variable is a percentage change as a function of a set of explanatory variables, which include the initial year income of the household, so income at the beginning of the year, and then a set of demographic characteristics of the household head and of the household members, physical and human assets of household head and household members, employment status and occupation, again, of the household head and household members, and our key variable, access to credit, measured at the beginning of the period. So we look at the growth of household income from t minus 1 to t, and our key variable is whether the household had access to credit at the beginning of the period. This rather simple, function can be estimated through this equation, in which we added a set of dummy variables which identify the periods in which we observe income mobility. Because a major feature and advantage of the Russian data is that there is this unique longitudinal dimension, and that we can construct different periods in which we of mobility in which we observe the same households. So we have household fees effects because we observe this same household for 2 or more periods. So we can include, and then with advantage, all the advantages of fixed effect estimations. And then, of course, we include also period dumps to control for common effects for all households observed in one single year, and for the mobility of this year that might be due, for example, to economic cycle that affected income of all individuals in the same period. So this is the baseline, let's say, estimation. As you see, there is as one of explanatory variables income of the household at the beginning of the period. This is posing some issues in the sense that the literature, Ayala and Sastre and Woolard and Jenkins emphasized that initial income can suffer, especially if it's reported income, not true income, of some measurement errors, and so cause some spurious negative correlation or attenuation bias. So we use instrumental variables to derive a predicted instead of reported income using some instruments. We can go back to the details if we need to. But more importantly, I want to focus on another possible source of bias in our estimation, which is related to our variable of interest, because there is also a potential issue of endogeneity of a household credit to household initial conditions and expected income growth. Because of course, if you expect and can document that you are going to have an increase in income, it will be easier for you to get credit. So there is a reverse causality issue that needs to be tackled. How do we do that? First of all, we rely on fixed effect estimation, which is, again, as I want to emphasize, a major advantage of the data set. So we allow for unobserved time invariant household characteristics that could be driving the endogeneity. And we also use an instrumental variable fixed effect approach, instrumenting credit at the beginning of the period with three instruments that have the desirable validity and relevance conditions, and we will see in the estimates. And they are home ownership, so basically presence of collaterals, so home ownership, average of credit access for similar household and household head in the same region, and this is meant, as emphasized in the extensive literature, to capture the effect of peer effects. So if I'm a university professor and working in Perugia and I see that my colleagues all have access to credit, this impacts my decision to take credit as well. So these peer effects. And then also the number of bank branches per capita in the region provided by some Russian statistical office. And by the way, I need to thank Olga for having an update of this data, because I initially developed this paper when I was at BOFIT in Helsinki. And then for revision and extending the dataset, I had to go back and to have some more data. And I asked Olga, who kindly provided me this data. So there is a little piece of higher school of economics in this paper, and I'm grateful for that. Okay, as I said, we want to check also which channels drive credit, the effect of credit on mobility. So our working hypothesis. To do that, apart from this baseline model, we estimate other models which link access to credit to changes in the variables that we think could trigger income mobility. So labor supply at the extensive and intensive margin, job worker mismatch, and capital income. So for each of these variables that we call channel variable, CH, we estimate the changes, for example, in labor supplies at the intensive margin, so the number of hours worked by the household, the change over the period, on a set of explanatory variables that we have available, plus our key variable, so access to credit. And this coefficient, alpha 1, reveals and illustrates the effect of credit on this single channel. And we repeat the analysis for each of the channels. So labor supply, extensive margin, labor supply, intensive margin, mismatch of workers, and capital incomes. I only want to spend 1 minute on our definition of job worker mismatch. We use a statistical definition. So we define a mismatched worker, so an over-educated worker, if this person has a number of years of education higher one standard deviation than the average for the same occupation in the same industry. So if on average you need 15 years of education and you have more one standard deviation more of this, you are over-educated for this job. And this is has advantages and disadvantages, but our estimates are robust to many different definitions of mismatch. And then we also try to track all the steps. So from credit to one of the channel variables, and then from channel variables to income mobility. How do we do that? We use this three-way fixed effect recursive system of simultaneous equation, in which in the first one, you see here, this is simply the estimate, the instrumental variable estimate for the predicted credit. So this to avoid endogeneity. So this is the first equation. Then this predicted credit probability, let's say, is included in the channel variable, channel equation, which is corresponding conceptually to the first one, at the top of the slide. And then this predicted, this change in the channel, so let's say the change in labor supply triggered by access to credit, is included in the equation of income mobility. Why a simultaneous system of simultaneous equations? Because we have to include credit also in the third equation. Why? Because, of course, we want to capture the impact of credit on mobility, not only through the channel that we are considering, but also through other channels, because it's possible that there are channels that we did not consider. At the same time, you see that the initial income appears in all three equations, so you cannot estimate them separately. Of course, we also instrument the channel variable, let's say we use different set of instruments to be sure that we don't run into endogeneity or omitted variable bias and this kind of issues. Data are coming from Russian longitudinal monitoring survey 94 to 2018. We use household as the unit of reference. We have a short-run mobility sample, as I said, 12 intervals of 3 years. And then we make robustness checks for 5-year and 7-year intervals, so longer term income mobility. Our income measure is household total monetary equivalence income using modified OECD equivalent scale. And we have a number of explanatory and control variables, demographic, economic, labor market, and so on, related to the household head in terms of initial levels and changes. And we have these credit variables. We have different definitions. We use a dummy variable. If the household took money, these definitions come directly from the questionnaire. So dummy equals 1 if the household took money on credit in the last 30 days or spend money to repay credit in the last 30 days. So 1 if means the household had access to credit and 0 otherwise. Then we also use amount of credit repaid in logs and as percentage of income to check for some kind of over-indebtedness effect. And then also we run robustness checks using another variable that is available only from 2006 on, which is another dummy variable, which is equal to 1 if the household took a line of credit in the last 12 months. Here you have the sample characteristics, but I'm going to skip this, and we can go back if we need to. And here are some descriptive evidence. I'm not going to go into details of how these measures of mobility are constructed, but this is the classical income mobility measure index, which is fields and OC index. And it's basically an average of absolute changes of income over the period considered of all individual observations. So you look at the changes, you take the module, so the absolute value, and you make the average. And what you see here is that income mobility was very high until, I'm sorry, this is very small, but it was very high until the mid of the 2000, and then declined remarkably. And the same can be seen through the Shorrock's index, which has a similar interpretation. More important, not more important, but equally importantly, you see that the field and OC index can be decomposed into two components. One is related to transfers, so to transfers between households in the income distribution, and one is related to growth. And you see clearly that there is a break, so after 2004, 2006, in which not only mobility declined, but also the share of transfers became almost completely dominant. So, and this is the effect that also is found in the literature. So there was lower mobility, still higher than in Western Europe, for example, but there is lower mobility, and this mobility is due to transfers from rich to poor households, or vice versa, because here we are not distinguishing whether this is in which direction the transfers happen. So it's just that people, we know that households are exchanging their positions due to transfers, let's say, to different sizes of the slices of the pie. Okay, in the previous period, it was the pie that was enlarging, and so people were moving up. Okay, now the pie is remaining pretty much the same, and the relative size of the pie of the slices is different. In the bottom part of the slide, you see the field OC index again, but calculated in subsamples of households having access to credit, blue lines, and not having access to credit, the red lines. And you see that the red line, the blue lines are regularly over the red ones, meaning that there is some preliminary evidence that households with access to credit have higher income mobility on average. The same is revealed by average jump. This is the number of deciles that each household, on average, jumps from the beginning to the end of the period. And you see that, again, the blue line, households with credit, had an average jump higher than households with not credit. And this is interesting because this has some kind of, gives hints on the direction of the jump, because you see that it's increasing basically by two deciles on average, and less if you did not have access to credit. Results of our model. I'm going to summarize. I hope you can see the presentation, but I did not find a more friendly way of presenting them. So here you find, let me explain quickly, this top part of the table of the slide presents the drivers of short-run income mobility in Russia, so 3 years over this period. First column, you have a fixed effect, and then fixed effect instrumental variable, which is the one we want to believe more and we think should be believed. And there is a positive and significant impact of access to credit using credit dummy variable, the variable if you had credit or not, if the household had credit at the beginning of the period or not. And it's positive, significant, and also in terms of economic relevance is important, because you see that basically this result is saying that a household that had access to credit experiences in an income mobility, an income growth, higher 13% more, higher 13% than household not having had access to credit. And the result is confirmed on the right side of the slide. If we replace year dummies By year dummies, let me remind you that I mean dummies that identify the sub-periods on which we are observing income growth. If we replace them with some policy variables related to the government expenditure on education, the legal system, labor market regulation, and business regulation. So these factors all, on average, increase income mobility, but more importantly for our purposes, they don't impact on the sign and significance, and also on the magnitude of our coefficient of interest. If we replace the credit dummy variable with credit amount, so a continuous variable, we find again a positive effect for credit repaid in logs as a share of income, and credit obtained, so prepaid and obtained. If we include a quadratic term of credit repaid as a share of income, we find a nonlinearity. So basically, when you tend to be over indebted, so when the share of credit repaid, when the credit repaid is a high share of your income, the beneficial effect of credit tends to be lower. Probably you have some kind of over indebtedness effect. Which channels are driving this positive effect of credit on income growth? No, sorry. First, I want to show you something else very, very important. We are observing a very long period, so from 94 to 2008. But if we look at subperiods, we find something very interesting. In particular, the effect of credit is only significant after 2004. You see here in the first column, we included interaction term between credit and the dummy for the period after 2000, for the years after 2004, and is significant. And the period before is not significant. Then we split the sample between before 24, so 2004, and after 2004, and we find that the credit is significant only after 2004. Then we focus on the 2004-2008 period, and we find that it's significant, but a dummy for years after 2012 are again, the coefficient is again higher. As here, you see in the subperiods, the coefficient for the subsample of households from observed in 2012 to 2018 is double the size of the effect in the previous subperiod. And this leads us to our first tentative interpretation, and which is related to institutional settings, in particular to regulation and institutional arrangements of financial markets. We have been reading some literature about how financial markets and credit markets evolved in Russia, and we have identified at the beginning of the 2000s significant effort in terms of reforms that tried basically to address the many issues that emerged during the 90s due to this extensive deregulation of financial markets. So some new rules were introduced, and the literature at least reports that this created, reduced the problems related to the proliferation of banks that populated Russia in the first decade of transition, and introduced a bit more transparency and increased the quality of management. And the second wave, at the beginning of the 2010, also increased the efficiency of the system. So it might be that this role of credit mobility corresponds to an increasing of the efficiency and of the functioning and of the conservatism of the credit market in Russia, meaning that in order to have this beneficial effect on income growth, you need to have good functioning financial markets. Then here, I'm not going through this because we also observed some interesting heterogeneity in terms of impact of credit, depending on some household and household head characteristics. because I want to go to channels of transmission.
Cristiano, I'm
Yes.
sorry to interrupt you. We'd like to keep some time for discussion. So how much more time do you need to?
We have maybe 5 minutes.
Oh, that would be perfect. Thanks very much.
Okay, okay, thank you.
Yeah, of course.
Impact of credit on labor supply, over education, and capital incomes. So these are the results of the estimation of the channels. So if you might remember this first equation, how credit is impacting on change in the number of workers, so the number of family members who are employed, the change in the number of hours worked in the family, the change in the number of people overeducated, and the change in non-labor incomes. Again, for the whole sample and for the sub-period starting from 2004. What we find is that the only channel that turns out significant is the one at the labor supply at the intensive margin. So access to credit impacts positively on total hours worked, but no effects are found on the extensive margin, on job matching, and capital incomes. We find in our robustness check that also positive effects at the extensive margin emerge in mobility over 5 years or 7 years, which means that probably in the short run, adjustments are possible only in terms of how our worked, and this is consistent with this labor market specificities of Russia, while it takes more time to adjust in terms of number of employment. So you need more time to look for a job if you are not working and to get into employment. So there is a longer time effect. To conclude, this is almost the last slide. This three-way recursive system. You see here we have the impact of credit on channel variables. Credit has been instrumented, so there is another equation in which we instrument credit, and it's confirmed that credit has an impact only on hours worked, both the whole sample and the subsample 2004-2018. And it's confirmed also that now you see that these hours worked are included as regressors here, and hours worked driven by credit are also having an impact on labor, on income mobility. So it's confirmed that the only channel through which income mobility is affected by credit is hours worked. And again, if we look at longer mobility intervals, there is also an effect on the number of workers. Just to conclude very quickly, income mobility in Russia is still high, but has been decreasing in most recent years. Since mid-2000s, households with access to credit experienced higher mobility and higher probability of upwards movements. And we connected tentatively this evidence to the explanation of a better efficiency of the credit system and the credit markets. Credit has an impact on mobility through labor supply in the short run, and we find no evidence on job worker matching or capital incomes of credit on income. The main policy implication, and this is the way I would like to conclude, is that functioning credit markets can provide one possibility to boost individual incomes in the short run, which is something that we are all interested. I mean, of course, we are interested in longer time effects of credit and variables, but these short run effects are also very important, especially if you have to escape poverty traps or you have some kind of critical situation, like probably we are having now. So if credit has an impact even on short-term mobility, this is something that might be useful for policymakers in terms of policy action. Yeah, that's all for now, and I'm looking forward for your comments.
Very good. Thanks very much, Cristiano. And I would like now to invite comments and questions, please. Lots of food for thought.
There's like one question from Sergey in the chat.
All right. Yeah. Okay. So please have a look at the chat.
Who also is raising his hand. So.
Okay. Can you see the question, Cristiano?
Yes.
Okay. So would you please kindly answer?
No, wait. Sorry. No. Okay.
Okay.
Yeah.
Or perhaps Sergey.
So
just
okay, by Sergey. Okay.
Oh yeah.
In 2008-2019, the median income did not change much. Does it conflict with the story that easier credit of 2019 is helping mobility, providing better opportunities? Yeah, this is difficult to say. This is, as I said, what we are clearly observing is that income mobility, especially in the years you're mentioning, so after 2008, has not been triggered by generalized, let's say, growth in incomes. So, yeah, what we know from the data is that income mobility in Russia has been driven by redistribution, transfers. Okay, and if you also we are not saying that credit was easier. At least this is not what is emerging from our data or from the data we have available. So it's not that the share of households having access to credit increased in the period from 2008 to 2019. What we are arguing is that the way credit was allocated was probably better. I can probably show you. I can probably show you. Yeah, wait a second. In the this descriptive table that I did not show you. Let me share the screen again. Sorry for that. Here you see. I think you see now this descriptive table, and you see that this dummy is not showing that over time, okay, credit increased so much. So starting from 2008, 24% of household had access to credit, and then it went up, and then it went down again to 2018. And this is the same if we use this other variable. So I would not say that we can interpret this as a easier access to credit, at least due to what the data are revealing. So I don't know if this is something that if this is what you meant, but we are not saying that that we are that credit was easier. In a way, it was the other way around. It was more selective the way credit was allocated. It was more conservative. The model became more conservative. But this is what we can say based on on the literature. It is likely that you have a completely different perception, and the right one is yours. So yeah, maybe. Yeah.
Okay. Thanks. Anyone else, please? Cristiano, if I may, do you distinguish between different types of credits, such as regular? Can you hear me? Such as regular bank loans, credit card balances, mortgages, and shark loans, microfinance. Because these are very different types of credit arrangements, and I think they might have different reasons to be used and different applications for mobility.
You're right. This is a crucial information, and we did not distinguish because we looked into data, and there is limited availability of information on the purpose of the credit taken. So
And the source of the credit?
No, not on the source.
No,
Not
on the source.
No, not on the source. There is a question on the purpose of the credit, but there are many missing variables, many missing values. So
because there is anecdotal evidence that people resort to credit as a last resort. They lose their income, and as a result, they carry big balances on their credit cards and borrow from loan sharks, and as a result, get in deep trouble. So that probably would not help a great deal with income mobility. Just a matter of necessity. To keep ends meet.
Yeah, and of course, consumer
especially
credit is,
lately.
Yeah.
Okay, Kun, you have a question, please.
Yes, my question is very much related indeed. So your story is about income mobility, but there's an alternative interpretation much in line with what just was said. So imagine I have access to consumer credits, and imagine the regime likes this consumer credit because it keeps people happy, at least in the short run, because they can consume more. So if you do not use this money to invest or be an entrepreneur, but to consume, what then happens is just you will need to pay back. And to pay back, you're going to have to work more hours. So that would not be productivity enhancing or anything like this. And in fact, it seems to me that the results point in that direction, because if it were really income mobility in the sense of stimulating entrepreneurship, you would see more people. You would see the extensive margin. But it's actually the intensive margin. It's the same people working more hours. It's also not people changing jobs. So it's none of these challenges. It's only you working more. So that seems not to point to better allocation, but it seems to point indeed to this microcredit literature, where sometimes microcredit increases consumption, but not so much production, and makes people dependent, having to work more hours for the consumption, which is not necessarily bad, but it's also not the story. So this is my remark, and then I have a real question on the results. I noticed that when you presented your results, the IV coefficients were not only more significant, but a lot larger than the OLS coefficients. And the gap was really striking. So that worries me a little bit. Could you explain where that comes from? And could it be that, so credit, extra credit is your treatment? And if the instrumental result is so much stronger than the OLS result, it seems to suggest that in your instrumentation, you have selected probably those guys that actually are more likely to take credit for consumption. And that's why you have these big results. So is there an issue with your instrumental variables in a way?
Yeah, thank you. Thank you very much, Koen. Regarding your remark, you're completely right. And and this is something that we also mentioned in our comments, that considering the results we get, we can talk about income mobility, but we cannot talk about welfare increases of households, because you probably take credit, and then to repay the credit, you have to work more. I mean, you earn more, but you have to work more. So this is very questionable whether this is leading to an increase of your welfare or well-being. Related to instrumental variables, you are right. The coefficient is almost 10 times higher. Yes. And it is possible that you have this effect that you mentioned. At the same time, it was not possible for us to control for some kind of let's say credit rationing effect, because to do that you have to have information on which households applied for credit and did not get it, and which households applied and got the credit. So to control for this, credit rationing.
There's no question somewhere in the RLMS that hints to this in any way?
No, we did not find it, because and we are pretty sure, because one reviewer, of course, raised this point too, and we just said, yeah, it's simply not possible in this data set that has many advantages but has not a direct question on this. So yeah, this is also emphasized in the paper as one possible bias of the this. Thank you.
Okay, thanks. Please, any further questions? Any
yes,
comments?
Olga Kusina, please Okay.
Olga, right? Hello, Olga?
Yeah. Can you hear me?
Please, the
Okay,
floor is yours. Yeah,
just
of course.
one comment rather than question, because you showed in your data, in your research, that there is a difference between the effect of credit on labor mobility or on income mobility starting with 2004, yeah, something like that. And in fact, I'm maybe this is a question. I'm quite surprised because surprised in terms of credit which you have found in the data before 2004, because in fact in Russia we have the process of mass, when banks started to give credits to people, it started in 2004, 2005. Even before that, we even had a kind of income taxation where you get a credit, it was considered as income and you have to pay the income tax. And only in the mid of 2000s, this taxation was changed, and banks started to give credits to people massively. And before there were no banking credit, it was just a single, sometimes people were able to get a credit because they have known the banker, yeah, or something like that. And so we can start the history of bank credits only in the middle of 2000s. And so what kind of question did you use before? Because before, if it was a credit like have you taken a credit, or have you paid the credit within the last 12 or 13 days, it was most of the time probably credits from your friends or your relatives. And in Russia, those kind of credits, they are very often sort of credits, but in fact they are gifts and transfers not to pay, because you know that that's not you are not paying back your debts to your friends or relatives, or as for banks. You pay them when you have funds to repay them. It's not like every month on a monthly basis you give back your credit. And so probably that is why you have this shift in the data, because of this change between 2004 and before it.
Yeah, thank you very much. This is a very interesting information. Yeah, the question is the same for the whole period. So you have the same question about this credit taken or repaid in the last 30 days. So we take this as a second best, of course, information on having access to credit. And so yeah, it's possible that since we don't know which income, which is the source of credit, it is possible that it's some kind of informal source, which makes a big difference. But thank you for this comment, because one of the issues we are fighting a bit more with the editor of the journal is that she wants us to identify why 2004 is such a dividing year. So this change in taxation is also probably a factor that is crucial. And so thank you very much. We will go.
Yeah, and another issue is that when you speak about bank credits, it's not only the wish of a client to take a credit, but it is also because banks give you the credit and they do scoring. And probably when you see that taking a credit increases the probability of, or increases the level of income in the further periods, maybe it is when scoring is done in this kind of good way, and then banks understand that these people are going to improve, and that is why it is safe to give them credits. Yeah. And so it's not like you have this kind of real effect of, because what is an effect when you will distribute credits on a random basis, and those people who are taken then they show the increase in their income, that is an effect of a credit. Yeah. But I think here you have this indigeneity, which probably is not fully taken by your IVA approach.
Yeah, we try to do something about it.
Okay, very good. Cristiano, there was a comment from Masha Semenova.
Yes,
I don't think it's a question, just if you would care to respond.
And improve risk management?
Yeah.
Yeah, okay. So this is also in the same line. So in 2000s, yeah, okay. This is what we more or less identified in this kind of new regulations introduced at the beginning of the 2000s. So yeah, thank you, Maria. That is also very interesting.
Could you please remind me what is the latest time that you have your data for?
2018.
Okay. How long will it take to get data for more recent time, for 19, maybe even 20?
I have no idea, but I think, yeah, for 2019, it will not take long as a reference year, because, yeah.
The reason I ask is that COVID might have been, you know, a source of exogenous variation, and
yeah.
it's a shock, and you can do some deep analysis, because people would be taking credits for different reasons last year than it was before. Last year, it was for many people a matter of survival, or just to carry through the spirit of unemployment and all sorts of economic upheaval. So maybe some of these effects would be sharper.
Yeah,
it might be. But if you have to wait a long time until you get hold of that data, then of course that wouldn't be a realistic option.
Yeah, I think this 2018 was released.
Okay, well, Sergey says the same, right? We probably, oh, you probably don't need 2020. Okay, maybe, right? But anyway. Okay, fair enough. Please, anyone else? Any other comments? Any other questions? I do not see anyone, which means that it's probably time to thank Cristiano very much for presenting his work. I'd like to wish him good luck with publishing the paper. I think that's something which is about to happen soon. And also we would very much like to see him live at HSC once again when all of this is said and done. Cristiano, thanks. Stay safe, and thanks very much for finding time to present it here. It was great to see you again.
Thank you. Thank you to all of you. And yeah, we will meet again, because I think we agreed with Bernardo to meet again for another seminar in June, probably with another paper we have with Marko Vladislavich, my co-author from Serbia, about child penalty of Russian mothers, which is another very interesting topic on the same dataset. So we will meet again soon, but above all, I would like to meet you in person. So let's make everything possible when we will all be safe to meet here or there, wherever it will be possible.
You're here, fingers crossed. Bernardo, could you please remind us what's coming up next week, please?
Yes, well, I would like to join Leonid, and thank you, Cristiano, for your presentation. Yes, so next week, Thursday, 11th of February, we have Jan Bietenbeck. Maybe I didn't pronounce his name correctly. He is from Lund University, and he's going to present his paper on own motivation, peer motivation, and educational success. So 10 minutes past 6 Moscow time as usual. Thanks everyone for joining, and we hope to see you next week.
Thanks very much.
Thank you.
Okay, bye-bye everyone.
Bye.
Be safe. Take care.
Bye, Leonid.
Thanks.
Bye.
Bye.